Hi, I'm Jonas Martenson. I'm the founder of Rest Capital. I've been involved in an asset class which is very interesting and offers truly uncorrelated returns, namely the secondary market for US life insurance policies, also known as life settlements. And joining me today, I have the pleasure of welcoming Scott Hawkins from Conning. And please, Scott.
Good morning, everyone. I'm Scott Hawkins, as Jonas said. I'm with Conning, where I'm a managing director and head of insurance research. Conning is a global institutional asset manager. One of the things we offer our clients is strategic research, and life settlements is an area we've been covering since the early 2000s. I produce an annual report on the state of the life settlement market, something I've been actively following for over 15 years. It's good to be here this morning.
Thank you so much, Scott. And you recently joined us at a conference hosted by the European Life Settlement Association in Stockholm. And one of the areas we discussed there was the ethical aspects of investing in life insurance policies. Sometimes we hear investors saying that they believe this is unethical, that you're profiting from someone dying. And I just want to kind of go straight into that subject because I think it's completely wrong since what the market does offer is an alternative to just selling your policy or lapsing your policy. And I wanted to ask you, Scott, I mean, there are some really big numbers there, policies which are lapsing, paying zero to the consumer. And of course, the surrender value being much lower than what the secondary market would offer when we buy policies. What are some of your thoughts and comments on why this misunderstanding about the ethical aspects?
So part of it is because of the some early press that happened. We're talking 15, 20 years ago when this market started to evolve. There was a lot of negative press about the nature of the transactions. Um, but at the bottom line, you hit the point on the head. Uh, in the US, a life insurance policy is a financial asset, just as if you were owning a stock or a bond. The Supreme Court ruled in 1913 that it's perfectly legal for an individual who owns a life insurance policy to sell that policy. They can use it as collateral for a loan, for instance. Um, but when they wanted to, let's say, reach a point where they no longer needed that policy, they were limited for the longest time to either surrendering the policy for whatever the insurance company offered as a cash value surrender, or lapsing the policy, quitting to pay the premium, in which case they lose any accumulated value whatsoever. The emergence of the life settlement market and the investors who supply the capital to that provided a third alternative. The life insurance owner can now go to the market, get a fair market value for that policy, and sell it. It's then the investor who assumes all of the risks associated with paying the premiums and the longevity risks associated with it. But for the original owner, the policy owner, they've benefited by usually getting a much higher return on their policy in terms of cash value than if they were to surrender it or just lapse it right out. So, from an ethical perspective, we think it's very ethical for the policy owner to be selling their policy. It's certainly legal, and for the investors supplying capital, they are providing some good for the consumer who's now turning their financial asset into a liquid financial asset.
And obviously, being a fund manager in this asset class since close to 15 years, we would, of course, agree that we believe this is very good for the consumer. Mr. and Mrs. Smith can sell a policy at a much higher price. But I've seen this market grow over the years, but it's still not growing substantially. And I know, Scott, you've done some research on the potential size of the market. So when we look at the secondary market, Mr. and Mrs. Smith selling a single policy, that market is somewhere like $4.5 to $5 billion annual volume. But you've done some research to indicate that it could actually be much larger if people were aware that they can sell the policy instead of lapsing it.
Absolutely. So, when we look at the market, we really look at a couple of metrics for it. There's what we refer to as the gross market potential. There's certain sets of criteria that an investor looks for in a life settlement in terms of the age of the insured, the type of policy, the policy amount. You can use those factors to identify what the full potential size of this market is. But that gross potential, which is in a couple of $100 billion of face, has to be reduced by the fact that most policy owners and most advisors to those policy owners are not aware of the life settlement option. So we always factor that down to get what's known as the net potential. That is, if everybody who was aware of the option wanted to settle their policy, how much would that face value be? So that's in the neighborhood of around 150 to 180 billion we projected over time. So why is the annual amount so low? Well, the annual amount so low primarily because the education, the awareness about life settlements among advisors and policy owners hasn't fully reached out there yet. There are firms that are advertising the opportunity to do a life settlement, but the broad awareness among consumers and policy owners and their advisors is just not there yet. As a result, the market's staying relatively slow and low in terms of annual volume. Our argument has been you increase the awareness, you're going to increase the volume. There is a constricting factor, which is, of course, the capital that comes into the market. So, in other words, investors have to be aware of the market, be comfortable with the risk, and then be willing to invest in funds such as what you have at risk in order to supply the capital to buy those policies. So, on the one hand, the supply is from awareness, the demand to buy those policies has to come from the investors.
Thank you, Scott. I mean, I think we as a fund manager at Rest Capital, we face to some degree the same dilemma where there's a bit of a chicken and egg situation. If you are an investor in this asset class, it's difficult to deploy huge amounts of capital. So some of the larger institutional investors cannot invest sufficient amounts in this asset class. But on the other hand, what the asset class does offer is something which is quite unique, truly uncorrelated returns. And of course, the correlation to equities, bonds, real estate is pretty much zero or negative. Since the key risk we take in this asset class is longevity, the
Mhm.
fact that people live longer and longer. So I think it has some really good benefits for investors looking to diversify their portfolios. And I also think the market has become very much more professional and regulated. And Scott, you have some comments maybe on the regulatory landscape right now, because it's pretty much regulated in all states in the US these days.
Yeah, I mean, I've been following this market long enough to remember in the very early days, we're talking in the early 2000s, the market was very new. There was not a lot of regulation around the sale of the policy. That meant that there was, people who were selling policies did not understand exactly what they were selling. Some of the buyers that were buying didn't fully understand all the complexities that they were getting into. So there was a lot of misinformation, mis-selling that went on. The state stepped in the late 2007 to 2010 range and started putting real regulations around the sale of a policy so that the policyholder is much more fully informed of what they're doing, what they're getting, all the fees that they're paying. So that was a big regulatory issue that came in. The other issue that's been settled not by regulators but in courts is some of the life insurance companies contested the claims and they would file suit against the life settlement investor, and those went to court and have been litigated out most often than not favorably for the investor, which is good because it's saying that the courts are recognizing that the investor, if the sale is done properly and they've owned the policy long enough, it's a legitimate transaction, and the courts will uphold the death claim that is paid to the investor. It's an important regulatory step.
Yeah, and I think it's for us as at Rest Capital, when we speak to investors, this is a very strong argument towards our investors. And our investors are pretty much pension funds, insurance companies, family
Mhm.
offices in the US, Europe, and the Far East. And I think investing in an asset class which is nowadays better regulated, where the seller will receive the best price possible for their policy, is really making this asset class a better asset class. And what we also see is that the transparency is much better, where the insureds, beneficiary have to agree. Do you have any comments on that, Scott?
Comments on the nature of the
No, I was
business?
just thinking about from, the fact that the beneficiary now has to agree to the transaction taking place.
Yeah.
Because if there are more states specifying that the life insurance companies would have to inform the insured that they can actually sell a policy
Yeah.
in the documentation, would that not make the market
So
larger?
yeah, you're hitting on a point that's sort of here in the U.S. because of our Social Security Medicare system. Retirees often need ways to fund their long-term care, and some states are putting in regulations that require the insurance company to provide a life settlement awareness notification as a way of generating funds to pay for long-term care. That's more about the states reducing their need to pay for Medicare for long-term care out of their own state budgets. And finding another source for that long-term care is crucial for some states, and that does increase the amount of awareness. The question will become whether those policies, which could be very small, would be attractive enough to the investors in the current market climate.
Thanks, Scott. So we've seen this market grow over the past few years, and it's approximately $5 billion now in the secondary market.
Mhm.
Then we have another market segment, which we internally kind of tend to call the tertiary market or the portfolio market, but really it's more like secondaries trading between larger fund managers, whereby one fund manager is selling, another one is buying. That market, the size is quite difficult to estimate, but maybe perhaps 150, $100 billion, $150 billion. What are your thoughts on this tertiary market? And is that different very much from the secondary market?
It is different. It has both advantages and disadvantages. If you are an investor moving into the space and you want to accumulate a policy very quickly, a portfolio quickly, you've got capital, you need to put it to work. If you go buy policies one at a time, that could take time. On the other hand, if you go to the tertiary market, you can acquire a portfolio of policies that's already been pre-built, pre-owned. Um, that's the advantage. The disadvantage is you really have to do the due diligence on that portfolio the way you would any other group of assets. You'll want to know what's the vintages of the policies, when were they purchased, what was the nature of the documentation around the sale. Remember, I said that in the early days of this asset class, the sales documentation was much less than it has become. So you'll want to pay attention to that. You may also want to take a look at what the individual policies are and trying to understand what the risks are that you're assuming in there. So those are the disadvantages. But again, the big advantage is you can go to the tertiary market and acquire a policy portfolio set very, very quickly rather than having to buy them one or two at a time.
And I can only agree. At Rest Capital, we've been running a listed life settlements fund since 13 years. The fund is listed at Nasdaq Nordic, and the net return target there is approximately 7% in US dollars. So we would obviously have to hold slightly more cash, which we do in treasury bills, to allow redemptions. And while in a closed-end fund, buying portfolios can be more efficient from a cash management point of view. And I think for a larger investor, it's also pretty difficult to go into the secondary market where you buy single policies, because most fund managers, they can't really deploy large amounts of cash, because obviously in our case, we've looked at 30,000 policies and we bought maybe 700 since 13 years. But I think the tertiary market now is really interesting, offers some really attractive IRRs. What we have seen recently is that the gross IRRs have gone up considerably more in the tertiary market than the secondary market. And we believe that is because we have some distressed sellers, some leveraged fund managers who are looking to sell blocks of policies, which creates very interesting opportunities. And as a result, we are now in the process of raising $600 million for a closed-end fund to benefit from this, dislocation in the tertiary market, where we believe that we will see more and more distressed sellers looking to offload blocks of policies. Because at the end of the day, if you can't pay premiums for the policies you own, that's the worst scenario outcome, always, of course. And we also believe there are some fund managers who are looking to deleverage. Have you seen anything like this, Scott, when you speak to people, what's happening in the tertiary market?
So in the tertiary market, what we're basically, from our research, what we look at is trying to sort of understand what the broad trends are. We know, like was mentioning, that it is still popular with investors looking to acquire blocks of business. But beyond that, we don't really follow the tertiary that closely, other than to say that it is an important avenue for the resale of policies, and that investors in it have become much more sophisticated and understanding the risks that they're picking up in these blocks of policies. We focus a lot more on the secondary sale.
Okay, no, I'm with you there. No, I think from our view, from a fund manager's point of view, at Rest Capital, we have seen many things become a bit much more professional in the market.
Mhm.
The medical underwriters providing the life expectancy, which we and other fund managers use, they are generally speaking of a better quality. And I think the understanding of longevity has become a lot better from pretty much every fund manager and most participants in this market since I started looking at this market close to 20 years ago. But really appreciate, Scott, that you took the time to discuss the market and your research. So big thank you, Scott,
My
for joining
pleasure.
us.
Thank you.